Hey everybody, Jeff Beers here from 40 Finance, and today we're going to talk about the worst investments you can make with your money. The worst investments you can make with your money. And we work very hard for our money. We know that over time our money actually loses against inflation, growth, and everything else. So making wise investments is the only way to really keep your head above water, and making poor investments can set you back literally for years. So I'm going to cover some of the worst investments that I'm aware of. Feel free to share some others in the comments. Number one, and this is one that I think we've all faced at some point or another, is debt. Okay? So debt. Debt works against your money. Whether it's credit card debt, student loan debt, etc. If you don't pay off your debt before you invest, you're still losing money because of the way you can balance out some interest rates and see which one has the highest and try to play that game. But at the end of the day, if you're putting money into investments before you take care of a substantial debt, then you're still swimming upstream. For number two, the second worst investment is savings. Savings accounts. Okay, I've talked about this in a previous video, but your average everyday savings account at your bank down the street is literally paying you pennies a year. At the end of a year with $1,000, you may make $2 or something like that. And that might actually be high. I haven't looked at the rates in a long time. They're not even worth looking at because it's pennies on the dollar. So savings is a terrible investment for the long term. Savings for emergency funds and things, short-term obligations that you might have coming up, totally makes sense to keep that money off to the side, but it is not an investment. Your money does not grow there. Number three, and this is another popular one, penny stocks. So penny stocks get a lot of attention, particularly on the internet, people promoting penny stock courses, day trading, etc. They're volatile. That's the bottom line. If you can't spend 24 hours a day, 7 days a week, monitoring and learning about your penny stocks, you're not going to win. It just, an entire game can be wiped out in a matter of hours. Everything that's on a penny stock is basically as a distressed company or a company that is barely hanging on to their public shareholdings. So not a good investment, very risky, and any gains you make over, say, 6 months, you did really well on penny stocks and whatnot, you can get wiped out in a matter of minutes the very next day. So not a good investment. Number four is collectibles. So when I talk about collectibles, baseball cards, stamps, purses. I know some ladies like to collect purses, antiques, things of that nature. They're not really good investment strategies. I would say that some collectibles can be a good storage of wealth if you have additional money that you're looking, that you don't want everything in the stock market, you don't want everything in a retirement fund. If you have a collectible that's valuable and you anticipate that it will continue to be valuable, it can be part of a storage of wealth, much like gold or silver. But at the end of the day, collectibles do not have a finite value. They are worth what people will pay for them. So if you have a Joe Montana football of some kind, and you bought it for $1,000 with the anticipation that 20 years from now it's worth $10,000, it doesn't really work that way. Joe Montana is signing footballs every day across the United States for every card show and banquet that he goes to. Your football is only worth what people will pay for it. And if Joe Montana goes on an autograph spree, or the market is dumping their collectibles at the same time as you, then you can expect to have a very poor return for whatever you paid for that. So collectibles is one of the worst investments. Number five, if you've got a family like I do and you've been pitched a timeshare, timeshares are awful. I think that's gotten a lot more publicity lately, so most of you are probably familiar with the fact that Timeshare is not an appreciating asset. If anything, it's just a debt instrument, because you have to pay so much per year for these vacation packages, whether you use them or not. I've never really understood the value of booking a vacation years in advance, and then committing to a chain or a place for even further in advance, because life changes so rapidly, and frankly the travel world is moving very quickly with the internet. So why you would commit to a vacation 3 to 5 years in advance and pay for that doesn't seem like a good idea. But for the same reason as collectibles, timeshares are only worth what the market will pay, right? And so most of the people, if you think about Airbnb, if you think about the competitive nature of the hotel environment, if you're trying to sell your timeshare to get out of it, people are only going to pay you a fraction of what you paid, right? It doesn't have an inherent value that's the same as the price, the same as the retail price, right? If I can just call up Marriott and sign up for the same thing you have, but they'll probably throw in some things at the same price, why would I buy it from you for that price? If I'm going to buy it from you, I'm going to buy it for 50% less, 40% less, or more. And then, of course, you've lost money, making timeshares a terrible investment and not one you should count on for your future. Last one I'll cover here today, as far as worst investments, it's a two-part word. If you or two-word phrase, if you want to try and guess it, it's also popular. It is new cars. Okay, so new cars. And I like cars, okay? I don't drive a 1998 station wagon with 600,000 miles on it. I like to have a newer car, but I will tell you that every time I purchase a car, it's at least 2 years old, okay? Because when you pull these things off the lot, as most of you know, you're losing 5% of the value just by driving it away. And cars don't go up in value, they go down in value. So while I think that cars are not only necessary, because there's an inherent cost of transportation, never buy a new car and think that you're investing for your future, because you're actually just paying for transportation on an asset that almost certainly will decline in value. And even vintage cars, for some reason, or as another example, those would fall in the collectibles department. So if you have an old Jaguar, BMW, or even if you had like a Ferrari or Lamborghini, those are collectibles. So once again, you're at the mercy of what people will pay, and it's very unlikely that you're going to make a lot more money than what you paid for it, okay? The exception would be if you had an old car, a classic car that you restored in your garage as a pastime. You might make some money off of that, depending on, you know, how you structured it with the parts and stuff, and if you're looking to make a gain. But typically, the only person making money off of a car or a car purchase is a mechanic or a dealership. So cars are not investments. And with that, these are the sort of top 6 worst investments that I could think of. Include any others that you have below. Thank you for watching, and catch me next time. Thanks.